Welcome back to Investing Wizards. We have Gavin Baker, founder of Atreides Management. And because Gavin works at a hedge fund, I need to read a disclosure first. So all opinions expressed by Gavin Baker in this podcast are solely his opinions and do not necessarily reflect the opinion of Atreides Management LP. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of Atreides may maintain positions in the securities discussed in this podcast. Atreides has invested in Koyfin as a seed investor. All right, now that we have that disclosure out of the way, wanted to introduce Gavin. Gavin, thanks for joining us.
Awesome to be here, Rob.
Great to have you. So we met on the internet about a year ago, and as I mentioned, you're a seed investor in Koyfin, and very happy to have you on board on our journey. But today we're going to focus on sort of public markets investing and your background. So can you tell viewers about your background and what school you went to and how you got started in investing?
Sure. Well, first, I feel like I should say, personally, I do love Koyfin, and that's how we came to know each other. And I guess Atreides came to be an investor in Koyfin, but I had a year where I did not work as a professional investor, and I extensively investigated all of kind of the free investing tools available on the internet. And I thought that Koyfin was by far the best. And I was happy to see you win that Twitter poll run by Patrick O'Shaughnessy, where
please go on.
Yes, that's where you guys decisively won.
But it really is,
yeah, it really is. It really is awesome, and I do go to even now having a lot of resources. I do find myself going to Koyfin a lot for its simplicity, ease of use, elegance. But to answer your question, I grew up in Houston, Texas. I had zero interest in the stock market growing up, but my entire life, from some of my very earliest memories are being interested in history. So I loved, before I could barely read, to read almost, picture books about the Greeks, the Romans, the Egyptians, ancient civilizations. I vividly remember in second grade, my dad would drive me to school every day and drop me off. And I'm sure, my dad also loves history, but I'm sure he'd been studying every night at the time. I was kind of in awe of his knowledge. But every day for the entire school year, we did the history of World War II kind of in chronological order, in little 15-minute slices, and I loved it. And, as I grew up, I read more and more history, and it was one of my favorite things to do. When I was 12 years old, there were these great Time Life series on like the Battle of Britain, the Air War, World War II, all sorts of really big illustrated 20-book series on major historical events, which I love. And then beginning freshman year of high school, I also kind of developed an intense interest in current events. So as a very, as a teenager, as a 14-year-old, I started reading the Houston Chronicle every day, the New York Times every day. I read every issue of The Economist, U.S. News, Time, Newsweek, and then when I got to college, I kind of still had those interests, and I began to get really interested in games of skill and chance, like poker and chess. But in college, the most important thing in my life, by far, were outdoor sports like rock climbing and skiing. I love to rock climb. I love to ski. My kind of stated intention was to, I'd worked in the ski industry for one winter during college. I was a housekeeper at the gold miner's daughter in Alta, Utah. I've cleaned a lot of toilets. And my stated plan was I was going to, after graduating from college, buy a really old pickup truck with a cap on the back, put a bed in the back of it, and kind of travel around the American West. I was going to work in the ski industry in the winter. I was going to work on a river in the summers, and I was going to climb full time in the shoulder seasons, and try and support myself also in the shoulder seasons, not only on the savings from those jobs, but on but by trying to to write articles, maybe take some wildlife photography, and try and write the next great American novel. I'm certain I would have failed at writing the next great American novel, at least. And I was an English and history major, and really no interest in the stock market, really no interest in investing, economics, anything. And my parents, I was very lucky, they paid for me to go to college. And they said, hey, Gavin, we really support this plan. We think it's a great plan. And they were kind of probably who I'd inherited a love of the outdoors for, because we did a lot of hiking trips growing up. But they said, we really support this, but we think we would really appreciate it if you would just do one professional internship. And I thought, wow, that's super reasonable. Of course, I'll do that. The only internship I could get was in the stock market. It was working for Donaldson, Lufkin, and Ginrette, actually here in Boston, where I'm based to this day. And I would say I have a very obsessive, addictive personality. Like if I get interested in something, I can just go really, really deep for a long time. And that's what happened to me with the stock market. After 2 days, I was done. It combined everything I'd ever been interested in. It was this giant game where your ability to win was based upon having the best, the most extensive possible knowledge of history, because while history does not repeat, it does rhyme. Mm-hmm. Intersecting that with the most up-to-date understanding of the present state of the world and future events, and intersecting those two to form a differential opinion about the future, different from what was discounted in the stock market, because the stock market is the world's biggest pari-mutuel system, where implied odds of different outcomes are always changing. And if you could, by intersecting the knowledge of history and current events, get an edge, it was kind of like competing in the world's most meritocratic game. It was a combination of poker and chess, where history and current events drove your edge. And I was super addicted. I would say I read a book on investing probably every 2 days on average for those 90 days. I lived in the basement of a woman's house in Cambridge. I never saw her, as she was renting out a room. And just, it was intensive study, 6 to 8 hours a day. I taught myself accounting. I read all Warren Buffett's letters to his shareholders. I read, just all, the Peter Lynch books, and I was completely hooked. I was going to Dartmouth at the time, Dartmouth College. I came back, I shifted my major from English and history to history and economics. Started what I termed an options trading hedge fund in college, and that started like a lifelong love and passion. I can still remember learning about return on invested capital, and how amazing that was to me, as a junior or senior in college, and the concept of incremental returns on incremental invested capital and reinvestment ratios.
So what year was this that you were at DLJ? Like, where was the market at the time? Not to date you, but
I believe it was 1996, and I actually kind of worked for I was an intern for the guy who ran the office, and I did a lot of things as an intern. But my favorite activity was I wrote up one stock a week, and then he would sit down and talk to me about it for an hour. And it was something that I've always remembered. So I did so much work and wrote this, enormous 15-page report on Cisco. I was so into the idea that it was the arms dealer for the internet, and it was going to grow with the internet. And I was spending a lot of time on the internet. Dartmouth was very early to email. It had something called Blitzmail. There wasn't such a thing as email at the time. They called it Blitzmail. And I was so excited about Cisco. But, the stock had been a really good stock, even as of maybe it's 97. It was either 96 or 97, but it had been a really good stock. And maybe, I don't know what the market cap was. Maybe it was a $10 billion market cap. We can go back and look. Um, and the head of the office, just looked at me and said, Gavin, there's all these great things about it, but how much more can it go up? And I was
Right.
just like, geez, I think we're really early in the internet. I think it could go up a lot. Um, and if you look at other technologies and, capital expenditures as a percentage of global GDP, and I'd gone back and I'd looked at, canals and railroads and all these things for kind of foundational technologies. And I was like, wow, I think we're very early. But he didn't love it. And he was a great man and a great investor. I learned a lot from him. But I do always think of that. Just because Cisco, I think it went up 20x in the next 4 years. So that was probably a pretty foundational experience for me as an investor.
Yeah, this internet thing is going to be big.
Yes. Yes.
And so that was kind of like it sounds like that was the basis of where you learned fundamental investing. And I know from our previous conversations, you use fundamental investing and technical investing, where you look at technical analysis. Where was the point where you started thinking about using technical analysis? And was it weird to you when you kind of like someone said to you the concept of, hey, looking at historical prices may have an impact or does have some predictive power of the future?
Yeah, well, so I do tend to have a very um, academic approach to things. And so I had done a lot of work on kind of behavioral finance inefficiencies as part of my economics major. And I actually wrote my senior thesis on reconciling the two most dominant statistical patterns in the stock market are actually long-term mean reversion and short-term momentum. So short-term return continuation. So in other words, over very short time frames, statistically, if a stock has been going up, it is likely to keep going up. And if it's been going down, it's likely to keep going down. That works really not much longer than 12 months, and 9 months is probably generally the sweet spot in a purely quantitative sense. This is not in a technical or chart sense. And then the reason there's a long-term mean reversion pattern in the stock market is because of capitalism. Just, an industry that's underperformed for a long time where the stocks have been going down, probably capacity is leaving. Whereas, an industry that's been going up, it attracts competition, it attracts capital, and that's why historically there has been mean reversion in the stock market. And, basically the two most powerful statistical factors in the market are actually valuation and momentum. And momentum is almost as powerful as valuation as a factor. So I was aware just from all of that academic work I had done and writing my senior thesis, that there actually was information contained in historical prices that was relevant for future predicting kind of future prices. And you can do a lot of things, if you intersect momentum with volume, it makes it even more powerful. And fundamentally, all quantitative investors, all they are doing is intersecting momentum with valuation. So I came into probably investing sympathetic to technical research, but because of that. And then, I read the, is it Terence O'Dean who wrote the paper on prospect theory? I believe it was. I read the prospect theory paper, which really kind of helped me understand why technical analysis works. Prospect theory is basically human beings feel the pain of losses twice as intensely as they feel the joy of gains. It's kind of like, there's a understood thing in kind of management that you almost have to give somebody 10 compliments for every one piece of criticism they give them, because we're all so much more sensitive to being wrong, to negativity. And fundamentally, that is why there is support and resistance, because of regret and people feeling acute regret that they didn't sell. And so when they get the chance to sell there again, they sell, and that's why there's resistance, and feel acute regret that they didn't buy at support levels. And basically, to me, prospect theory explains a lot of technical analysis. So I was very sympathetic to it. And then I would say, broadly speaking, while I will never buy a stock just because of its chart, it is an important input into my process. And by the way, I will buy stocks with terrible charts. I'm actually, hopelessly addicted to the 52-week low list. And even though that sounds smart, it's actually not smart statistically. Statistically, the smart place to work off of is the 52-week high low, 52-week high list, but I find myself drawn to the 52-week low list. So I will buy something on the fundamentals alone, even if it doesn't have a great chart. But I use, I think there was, I forget who it was. I think it was Bruce Kovner in Market Wizards. He said that, he just thought, technical analysis was part of his toolkit. It's like if, a doctor had a thermometer, technical analysis was his thermometer. You just kind of check the health of the patient. But I'd say the simplest and crudest way that I use charts is, and I do this less and less, but particularly when I was a newer fund manager, like I just start by looking at a 20-year chart. If, there was something that was new to me, the quickest way to determine if something is a good business, an average business, or a mediocre business is to look at the long-term chart. Good businesses, the charts are usually up and to the right. Average businesses, the charts are, they're, maybe more in line with the stock market. You want to look at both the chart of the equity itself and then versus the market. And then, charts of bad businesses, they're often long-term underperformers. So there's a 20-year chart can tell you a lot. And then I actually further intersect this, and this is a view that I use in Koyfin with earnings. It's over the long term, what drives almost all stocks is just growth in either earnings per share or free cash flow per share. It's amazing. If you look at a 20, 30, 40-year chart, whether it's Microsoft, whether it's Procter & Gamble, whether it's Coca-Cola, maybe less Coca-Cola and P&G recently, any business, with high returns on invested capital that's able to reinvest those at good rates, you can see it just goes up in lockstep with the earnings line. And if you scale them, so it's at about 20 times earnings, 15 to 20 times earnings, the lines are almost on top of each other for 20 to 30 to 40 year timeframes.
Kind of like
so I think there's
the compounders, right?
Yeah. And by the way, it's like, there's loads of ways to make money, and sometimes, there's these names that are just kind of wigglers instead of compounders. They just bounce around up and down, and they're very cyclical. And over the long term, they destroy value, but you make a lot of money buying them at the bottom and selling them at the top. I think it takes a high degree of skill and a lot of knowledge. But there's many ways to make money in the stock market.
Yeah, absolutely. And I think it's important for people to identify which is the way that they're good at or what fits their style, and really to focus on that and not try and be someone else.
Oh, yeah. I think the most important thing in investing is there's many ways to succeed as an investor. And ultimately, investing is all about finding the right balance between humility and conviction. And you have to find an investment style that fits your own personal emotional makeup. Because I think the most important factor in investing is the ability to be rational when wrong. So you have to find an investing philosophy or style where you really believe in it, you're really comfortable, you're going to stay with it, but that helps you be rational when you're wrong, because you're going to be wrong a lot, and it's really hard for most people to be rational when wrong. So I always think it's very strange that people have such strong views. This is not science. It's not like, there's only one theory of relativity. And even though the theory of special relativity doesn't actually explain everything, there's only one theory of gravity. The sun does rise in the east and set in the west because of the direction that the earth rotates. This is not science where there are established facts, or where theories are so well established and so well proven that they're basically facts. It's important to remember all of those are actually just hypotheses that are proven every millisecond. Investing, there's many ways to win. There's many ways to succeed. You can succeed as a value investor. You can succeed as a growth investor. You can succeed as a technical investor. You can succeed as a momentum investor. By the way, momentum investing and growth investing are often conflated. They're not the same. So I find it so strange that people have such strong views that their way of investing is the only way of investing. There are many ways to succeed. You just have to find the way that works for you as an investor, your own particular emotional makeup, and you have to stick with that.
And is there, and so what you're talking about in terms of being flexible and just being able to change your view, how do you balance that with just having conviction in something? And if something's going against you, having the conviction to see it through some temporary setbacks, like, is there anything that you've learned throughout your career, have seen others do that help you balance that?
Yeah, I mean, I think this is, Michael Steinhardt in Market Wizards said investing was all about finding the right balance between having the courage of your convictions relative to the flexibility to admit when you're wrong. So your largest position's down 50%. You've been wrong. A lot of people have this attitude, oh, I'm not wrong.
Just need to wait.
Yeah, you just need to wait. If you're down 50, you were wrong. A lot of people say, oh, it's just early. A former Fidelity colleague of mine named George Vanderheiden was fond of saying, being too early is the same thing as being wrong. This is a very competitive, demanding pursuit. So it's down 50%. You've been wrong. Can you be rational? Take all the new information that led to the stock being down 50% and make the correct decision, which may be to double your position and maybe to do nothing because, hey, the story has changed and now your position's half what it was and that's the right position size. Or maybe it's to sell it all because the new information was fundamentally thesis changing. That's really hard to do. And that's why I think you have to have a philosophy that works for your own emotional makeup. It's not, some of the investors I know with the strongest stomachs are actually growth investors. And there's a lot of deep value investors who have very strong stomachs. There's some great research done showing that great value investors, differentiated themselves on the entry. Great growth investors differentiated themselves on the exit. You have to find what works for you. For me, it is feeling like, and I talked about this on Patrick O'Shaughnessy's podcast. So, I wrote a Medium article on it called "Investing in the Name of the Rose." But for me, feeling like I have a very high knowledge level helps me make good decisions when I am wrong. Because even when I have a high knowledge level, I'm wrong a lot. But when I feel like I have a high knowledge level and I'm wrong because of kind of a risk that I thought about, I find that I make better decisions. So that's what works for me. But everybody has to find what works for them.
Yeah, and another concept related to this, which you mentioned on Patrick's podcast, also from Investing Wizards, is that boulder on top of the mountain, and the boulder can go either way, and you really have to imagine what are the different scenarios where the boulder goes any which of the 360 degrees, especially in today's market where the boulder could literally go anywhere, and you could have a lot of different permutations.
Yeah. If you've said to yourself, here are the 7 big risks, here are the ones that I'm comfortable with, and here are the ones that if they materialize would really change the thesis. It makes it a lot easier. You almost, this is the whole concept of having a pre-mortem written for a position. In other words, if we were wrong, these are the 5, 7, 10 reasons that we were likely to be wrong. It's actually very funny. There's GPT-3, this new AI algorithm.
Yeah.
That if you feed it anything, it could spit out what it's often really impressive text afterwards. And I am tempted to experiment because one of the biggest things in investing are unknown unknowns. And GPT-3 was, trained on, an enormous corpus of written material. And I am interested to see, and I have no idea if it'll work, we haven't done it yet. But I'm interested to see that if I were to feed an investment thesis into GPT-3, and then here's the hypotheses that go into this. Here is an expected IRR in a base case and a bull case over the next 5 years. Here's the risk, and then say here are the risks that I really see, and then you ask GPT-3 to generate other risks. I'm curious if it will generate good unknown unknowns and thereby kind of convert, which are actually, if we're being very precise, uncertainties rather than risks. Uncertainty and risk are different things, and a set of bounded outcomes is risk. When the outcomes are unbounded, it's uncertainty. And so there are always definitionally uncertainties in the stock market because almost anything can happen. But can you turn a few unknown unknowns into known unknowns? Turn a few uncertainties into risks that, while you probably can't bound them precisely, you can begin to frame them.
Yeah, sounds like you want to automate away the analyst function, which
No.
I hope the analysts on your team are not watching this.
No, I'm a huge believer. In some ways, our iPhones and our Android devices are already personal AIs for us.
Right.
They know a lot about us. They know, they effectively know everything about us. They know where we are. They know who we're with. They know when we're sleeping. And, they can answer almost any question. But I do believe, human beings working in concert with artificial intelligence or computers are going to be able to produce superior outcomes than either humans alone or computers alone for many years to come. So I do not believe that analysts are going to be automated away anytime soon.
Yeah, and I think that probably goes for a lot of industries that people assume are going to be automated away. Cool. So, super interesting background, and thanks for sharing kind of how your investing style has evolved. Wanted to turn it over to maybe some specific investment ideas or investment themes that you're thinking about. And let me share Koyfin, and I'll kind of pull up charts as you're talking about different things.
Awesome. So I would say what I am most excited about right now is the higher semiconductor intensity of artificial intelligence relative to software written by human beings. And I think this may be one of the kind of most important investment themes over the next 10, 20, 30 years. And so kind of, how did we get here? Why is this important? Well, Mark Andreessen famously wrote this Wall Street Journal op-ed, I believe 8 years ago, entitled "Software is Eating the World," basically saying that every company was going to become a software company. Every industry is going to be dominated by software. And I think if you were to rewrite that essay today, you'd probably say artificial intelligence is eating the world. Because artificial intelligence is just another kind of software. Our AI is almost software written by software that was trained on a big data set. And you could almost think of software written by human beings as almost being an expert system. It's hand coded by a human being. If this happens, then that happens. And it's interesting, AI has been around for roughly 60 years now, and people were really excited about it in the 60s, 70s, and 80s. And then I think they quickly, neural networks were invented long ago, and I think they quickly realized that neural networks were kind of limited by the amount of compute power available. And then AI went through what was called an AI winter, where there was no progress, and the people who believed in it were Vox Clementis and Deserto, to reference my alma mater, a voice crying out in the wilderness. Yes, here's the chart of NVIDIA, which has certainly been central to artificial intelligence, and I can explain and I can talk about that. There's all sorts of stuff in symbolic systems, and just tried to teach an AI everything about the world, and then in 2006, a computer scientist, a woman named Fei Li, who is now a luminary of artificial intelligence, had the idea to create an enormous database of labeled images that she called ImageNet. And they actually had to use Amazon's Mechanical Turk service to label all the images. But this meant that you had an enormous data set that you could test various types of computer vision software on. And there are many different ways to do computer vision, and they started having an ImageNet competition. And deep learning was ported over to GPUs. NVIDIA wrote kind of a software that they call CUDA. You can think of it as a programming language or a programming environment, a tool chain for doing deep learning on GPUs. And GPUs that stands for Graphics Processing Unit, which are used to generate the 3D graphics that you see when you play a computer game, or you see any really kind of sophisticated animation. And fundamentally, 3D graphics are all about doing enormous amounts of very simple math really quickly. And you could almost think of the difference between a CPU and a GPU. The CPU processes instructions serially, and GPUs do them in parallel. And I think of CPU as being like a checkout register that can check out any item in the world. So it's like, you can picture the world's most sophisticated checkout system, and it can check out anything, ranging from a cow to a car to a fighter jet to a computer, to an apple, to a piece of meat, to a book, to a magazine. It can check anything out one after another so fast, boom, 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 boom. Whereas a GPU can only check out like 100 different things, but with that CPU, you really only have one checkout register, and you can have hundreds of checkout registers in a row if you're a GPU. So if you're a store that only sells a few things, it's much faster to check out through GPUs. And in this analogy, the software programs are the stores and the items that are being checked out, and the GPUs and the CPUs are the kind of checkout registers. So in 2012, a team led by Geoffrey Hinton, who is another luminary of artificial intelligence today, entered a deep neural network called AlexNet in the ImageNet competition, and they absolutely annihilated the computer vision software that had been written by human beings. And this was, tens of thousands of man hours of programming that had got into the best computer vision software humans could write, and it got annihilated by a deep neural network that had been sped up on GPUs. And that really actually kicked off the current kind of deep learning revolution, an artificial intelligence revolution. Jeff Bezos, it was a massive win. AlexNet won by an 11% margin, which doesn't sound like a lot, but it was 41% better. It's kind of like, nobody had broken the 4-minute mile. AlexNet ran it in 3 minutes, and the number 2 finisher was at 4.5 minutes. That's how big that margin of victory was. And then in 2014, it was over. 2013, the human beings were like, hey, we're going to come back. It was like that old story of, the steam engine versus, who was the guy splitting wood?
Paul Bunyan.
Yes, exactly. Yes, whatever it was. The steam engine eventually obviously won very decisively. And the humans said, "Oh, we're going to do a lot better in 2013. We're really going to get focused." They got annihilated again. And then in 2014, every submission was a deep neural network. And then, and this is why Jeff Bezos, in 2013, 2014, basically he observed there's been no change in algorithms. The algorithms we have been using are our really old algorithms. It just turned out for them to be accurate, we needed way more data and we needed way more compute. We had way more data, basically because smartphones are gathering so much unstructured data about the world. And then we had more compute because of cloud computing. So cloud computing was a very foundational invention and innovation enabling artificial intelligence. But I think we are going to come to stocks, but the fundamental thing, I think, to understand artificial intelligence, and this may be, I think, the single most important fact to understand the world we are living in, is that AI quality generally doubles with every 10x increase in the amount of data used to train the algorithm. This led to, and this really, so if you want to double AI quality, you need to spend a lot more compute. And compute means CPUs, GPUs, memory, everything, networking, all of it. It's all scaling. You need them in a roughly fixed ratio. If anything, the amount of memory needed, it may be growing even faster than the compute. That's debatable. We've actually just had a lot more architectural progress in compute than we have had in memory. I mean, there's been this explosion of GPUs getting better, TPUs from Google, lots of startups, just an explosion in architectural innovation. But I read an article in Wired in early 2017, and it was called "Building an AI Chips Saved Google from Building a Dozen New Data Centers." And basically what happened was they had realized that these same deep neural networks that were so effective at image recognition were incredibly good at speech recognition. Google was a big believer in voice search, and voice is a new UI, and that their new deep neural network for speech recognition, they realized, and Google at this point had probably $50 billion of CapEx in the ground in terms of data centers. Somebody fact check that number, but order, and I certainly did not look it up beforehand, but in 2017, Google had a lot of invested capital in data centers, and their engineers realized that if every Android phone on this planet used the new Google search algorithm for just 3 minutes, Google did not have enough capacity, and not only that, they needed to double the amount of compute capacity they had globally. And so that's actually why they why they designed the TPU, although I think the GPU progress has probably been a lot more rapid than they would have expected. But just you're seeing incredible, truly incredible progress. Like that AlexNet in 2012 was trained on 2 GPUs over 5 days. In 2019, it took 1,000 chips 6 days, and each one of those chips was probably 10 to 20x faster than those original GPUs. So the training time, had gone up. The training compute had gone up by kind of a, like a factor of probably 10 to 20,000. There's a English to French machine translation algorithm, and if you were to do the training necessary to take its accuracy from 50% to 10%. So in other words, 50% error rate to 10% error rate, so from 50% to 90%, you would require a billion times as much computation power. And stuff like this is why a lot of futurists believe in Dyson spheres, that eventually the compute needs of humanity will be so great that the raw energy required to run them will require a Dyson sphere, which means you will enclose the entire solar system with a bunch of reflectors that will gather solar energy to power compute. But anyway, so this is very exciting to me, and just, what it means in real terms, like to bring it back to, so there's NVIDIA. Almost all AI in the world today is trained on NVIDIA GPUs. A lot of inferencing happens on, Intel and AMD CPUs, then NVIDIA and AMD GPUs. But, NVIDIA, along with Google, really, from a factual market share position of AI training workloads, they do the majority of them today. There's loads of startups coming for NVIDIA. Jensen is a truly exceptional CEO. And an interesting kind of observation about digital processor markets is you've never really seen a number one unseated. So in other words, Intel's always been number one in x86 CPUs. NVIDIA's always been, number one in GPUs. Qualcomm has always been number one in basebands. And this is just, NVIDIA had an effort. Loads of people have tried to compete with Intel and CPUs. Loads of people have tried to compete with NVIDIA and GPUs. NVIDIA and Intel both tried to compete with Qualcomm and basebands. Digital processor markets, the barriers to entry are really underestimated. Code gets optimized for a specific flavor of CPU, GPU, or baseband, and that gives somebody said that it was an exorbitant privilege that the United States could borrow in its own currency. That the number one digital processor player enjoys the exorbitant privilege of having code optimized for their own specific architectures. But it's not just and by the way, AI training and inference, it is much more, it's more CPU intensive, it's more GPU intensive, it's more FPGA intensive, it's more AI accelerator intensive, it's more memory intensive, it's more networking intensive than software written by human beings. And that's really important to me as an investor, because if I believe that 40 or 50 years from now, it's probably going to be illegal for human beings to write software. AI will kind of run the world. Anything that one of these pioneers of AI research, I retweeted him, but he said, I found it mildly scary. Anything a human being can do, a deep neural network can do better if it is provided with sufficient data and enough compute training capacity. So AI will drive cars, fly the planes, steer boats, control traffic systems. Everything will be priced by AI. Advertising will be driven by AI. There's almost nothing that will not be touched by AI.
But that goes back to the analyst comment before. Do you think that that's going to be exclusively driven by AI, or there's going to be...
So the humans, the role of a human, the computer scientists, they will almost become hypothesis generators. They will frame problems. AI is brilliant but narrow today. It may become more robust if transfer learning ever works, but for now it's brilliant but narrow. And so the skill in human beings will almost be in choosing the data sets to train the AI on, understanding, framing the problems in the right AI. So there will be a role for human beings, but it will be very different. But this matters for semiconductors because definitionally, if all software runs on semiconductors today, definitionally. And if AI consumes more compute than software written by human beings, it consumes 6x the memory. Consumes 6x the memory, much more compute, much more networking, then the semiconductor intensity of software is going to go up significantly by 4 to 6x. So this means to me as an investor over the very long term that whatever the current semiconductor share of global GDP is, it should go up by at least a factor of 4, 5, or 6 over the next 10, 15, 20 years as it takes share. And then that's even more exciting. So that's the demand side. On the supply side, and by the way, you could pull up the SOX, the SMH. This is going to apply for memory makers, networking semiconductor makers, a wide variety, FPGAs. This is going to touch on a lot of semiconductors. Just if you want tickers, Intel and AMD make CPUs, Xilinx makes FPGAs, Micron and Samsung make memory, Lam Research and ASML make the equipment that you use for all of this, LRCX and ASML. Taiwan Semi makes a lot of these. This is going to touch almost all of semiconductors from a significant upward inflection in demand. And if you think about it, this is important because the semiconductor industry has absorbed two massive negative demand shocks over the last, call it 15 years. The first one was the iPhone. You would think that the iPhone was positive for demand. It was actually negative because what the iPhone did is it replaced PCs. People used to be able to confidently project that billions of people were going to have laptops. Well, they don't, and the reason is they have iPhones or Android phones. And even though there's a lot of semiconductors in an iPhone, a lot of semiconductor dollar content, it's lower than a laptop. So having iPhones replace laptops was a negative demand shock. And you saw that. You saw the replacement cycle for laptops extend. And then it had to absorb the negative demand shock of both virtualization and cloud computing, which really increased the utilization of the world's existing semiconductor infrastructure. That was a negative demand shock. We've kind of worked through both of those, and now we're going to have a positive demand shock from the AI intensity. And we're going to have that just as almost every semiconductor market has really consolidated. All of these markets, whether it's semiconductor equipment, whether it's memory, CPU, GPU, FPGA, they've become incredibly consolidated with extremely high barriers to entry. Brad Slingerland, who's an old friend, wrote this up, and we went back and forth on Twitter. And I am going to write a lot of this up in a Medium post at some point, Rob. But he basically, and I was talking about how high the barriers to entry were, that modern semiconductors are the closest thing to magic in the real world today. Just that you are manipulating wires, that are just, almost incredibly small. These wires, they're so thin that the human mind cannot really apprehend how small these wires are. And, the thousands of miles of wiring that are inside, a chip that's, the size of maybe two thumbnails put together. As it is so thin. It's the closest thing to magic. And Brad tweeted at me, magic has high barriers to entry. And that is going to be the title of my Medium post on this, which I'm writing. So you have this positive demand shock in the form of AI intensity, and then you've got a very consolidated industry. And look, a lot of technology investors have been very focused on software and internet for the last 10 years. And so semiconductor investing is a little bit of a lost art. I was a semiconductor analyst back in the year 2000, so I actually love it. It is, pull up ASML, Rob.
So ASML is is it a Dutch company? So I'm not
sure. It's a
okay.
It's a lithography company, and it is just amazing. It's like almost all human progress depends on this company. Okay. Because to keep Moore's law going, which is really important. Look, all these companies, all these processor companies, whether it's Intel, AMD, NVIDIA, Cerebras, Grok, Mythic AI, whoever you want to talk about. I should disclose Trades Management is an investor in Mythic AI, along with some of these other names, but they're getting a lot better architecture. It's squeezing more performance out of each generation of Moore's law. But to keep Moore's law going, ASML has to make progress. And humanity, we really need another 5 to 7x turns of Moore's law to unlock really amazing stuff in healthcare and material science. Really keep technological progress going. And then after Moore's law, there's all sorts of cool stuff we can do. Silicon photonics, using light instead of electricity. Quantum computing is super cool and beginning to work. Super cool, no pun intended. Super cooling. Cooling is a problem with quantum computing. But we're gonna chill conventional chips down to extremely low levels as a way to solve this. So there's a lot of neat stuff coming. But ASML, if you could pick one company on this planet, if kind of NVIDIA porting artificial intelligence to GPUs via CUDA, and by the way, the whole thing about parallel computing is artificial intelligence, deep neural networks, all they are is doing very simple math over and over again at massive scale, just like graphics. And that is why GPUs are good at artificial intelligence. Sorry to come back to that. I think maybe I'd forgotten to make that point. But kind of NVIDIA and their architectural work and their software work has kind of really underpinned the modern revolution in artificial intelligence. And I think really made a lasting contribution to kind of science and humanity. And look, now they're facing a massive wall of venture-funded competition. A VC evidently told the CEO Jensen that Jensen had single-handedly brought back semiconductor venture capital investing because people were so excited to fund competitors to NVIDIA. Lots of those are being acquired by Intel. Intel has its own big efforts. But ASML, lithography, they need to keep making progress to keep Moore's law going. Please, Rob.
So lithography again is more of like a semi-cap equipment concept in the supply chain. But I was going to ask you a couple of things based on what you said. So,
ask me anything.
Yeah. So the competitors that are coming online to compete with NVIDIA, before you mentioned as a student of history that industries are mean reverting and that success begets competition and then failure destroys competition and it's a natural cycle. And then you also mentioned kind of this concept of leadership in semiconductors and kind of leadership having a competitive edge over a long period of time, whether it's Intel or AT&T or whatever it is. So how do you think about NVIDIA being a leader and all these startups nipping at its heels? Will we be at a point where someone will succeed?
Well, just to address your first point about kind of mean reversion, one of the most fascinating things is until maybe 15 years ago, ROICs were highly mean reverting. So companies with high ROICs would generally see those ROICs mean revert over a period of time. That stopped being true roughly 15 years ago. And this is kind of well established. It's been all over Twitter. I forget which consult. It might have been Bain that did the work, but they've done this work and it's been extensively replicated. And you can see it. I mean, anybody with access to financial data can do it. But really high ROIC companies are maintaining those ROICs with no sign of those ROICs falling. And I think this goes back to, Brian Arthur, who kind of wrote a seminal paper, I believe in 1996 on increasing returns. There are in technology, there are, increasing returns to scale, network effects that lead to these ROICs being much more resistant to competition than in traditional industries. So for instance, the biggest risk to Google is that somebody invents an algorithm that actually changes this relationship between data quantity and AI quality, because the quality of Google search is really driven by the fact that they have more data than everyone else. They do more searches than everyone else on a daily basis, so their data moat is only growing. And so as long as data is the determining factor for the quality of their product, you actually, if you wanted to go spend $200 billion to compete with them, you still couldn't. Amazon tried to compete with them. They failed. They had a startup, I think they had a search engine, I think they called it Alexa. No, A123 is what they called it, I believe. They failed. Microsoft has largely failed. It is, these internet businesses are natural monopolies, the likes of which the world has never seen. And because of this relationship between data quantity and AI quality, and because of these increasing returns to scale and network effects. What do I mean by that? Railroads and cable were natural monopolies because, and utilities, they're natural monopolies because it only makes sense to have one. And it's so expensive to put it in. So let's put it in and then let's regulate them. And in the case of cable, it's not regulated because it was done with private capital. And that was largely enabled by the creation of the high yield debt markets. But these internet businesses, they're natural monopolies because once you get a dominant position, you have more data to train your algorithms. So your algorithms are always going to be better. And unless they hit some ceiling where quality no longer matters, and we have yet to find that, you can't spend any amount of money to compete with them. So for, if you wanted to compete with a utility or a cable company or a telecom company or a railroad, and you had an infinite amount of capital, you could. For these internet businesses, you can't. And so I think how you regulate them is going to be very interesting. And beyond algorithmic innovation, which I think of as the most important risk for any internet business, where their moat is kind of fundamentally the data quantity driving AI quality, leading to a better product. And then because they have the better product, they get more users and more usage, which gives them more data, which makes their product better, and that flywheel and that virtuous cycle spinning. Apart from algorithmic innovation, regulation is what really matters for all of these companies. And I do think that probably the most logical way to regulate them is actually to break them up. Because, fundamentally they are kind of giving, most of them are either free to the user or cheaper than alternatives. But anyways, so the statement I made about mean reversion has actually not been true for kind of 15 years. And it is easy to show that in the ROICs in the top decile, they are no longer mean reverting. But NVIDIA, look, the head of AI at NVIDIA was saying, look, everybody's trying to eat our lunch, but we're trying to keep our lunch moving pretty fast. And NVIDIA's a moving target. What they just unveiled with Ampere was, I think, pretty astonishing. And look, Cerebras, what they have done with wafer scale computing, that is a truly kind of fundamental, scientific engineering, technological breakthrough. They're going about it in a very different way. Intel bought Habana, which, and by the way, this is why NVIDIA bought Mellanox, because GPUs stop scaling linearly once you get, I think, to like 50 linked GPUs. And if you could put, we don't have to go into the details, but if you can embed the networking on the chip, they can scale linearly. So that's kind of, Habana's big advantage, and Intel bought them. And then you've got, Grok, which was started by the team that built the first TPU for Google. You have Google itself with its TPUs. You have a startup called Sambanova. You have a huge array of very well-funded venture companies going after NVIDIA. And then you have AMD, who, Lisa Su has done a great job. She's an exceptional executive. And they have both, CPUs and GPUs. Intel is trying to make a GPU of their own. This will be their kind of Um, they had a first try called Knightsbridge, which never really saw the light of day. This will be their second try. They're very serious. They've hired the former head of architecture at AMD to work with them on their GPU architecture. So we'll see. So look, there's a massive amount of competition coming for NVIDIA. And so they're going to have to run fast to keep their leadership position. But I do think it is interesting that the history of these digital processor markets and that exorbitant privilege kind of conferred by having software optimized, it's a powerful competitive advantage for any dominant processor company.
Yeah, and some of the kind of like secular trends that you're mentioning are evident in this market cap chart of AMD versus NVIDIA. And let me just put this on a linear scale to kind of show just the total magnitude, but obviously log scale, you could see the percent change a little bit better. AMD 4 years ago went from a 1 billion market cap to 70 billion today, and still trailing NVIDIA by a decent amount. How do you think about kind of like AMD versus NVIDIA going forward? Both are in the GPU market. Like how would you think about these companies strategically over the next 5 years?
Yeah, so I would say AMD has made, there's this legendary architect named Jim Keller, um, and he's one of, there's only a few truly great processor architects in the world, or kind of processor teams in the world. Um, and there are, by the way, a lot of the other dynamic we haven't talked about is ARM coming for x86, which is certainly a big cross current for both AMD and Intel. Um, and Apple is switching the MacBooks from x86 Intel chips to their own internally developed ARM-based chips, and these are all CPUs. And ARM is coming to the data center, and there's some really interesting um, ARM-based server CPU companies. But in terms of NVIDIA versus AMD, look, there's this AMD hired Jim Keller, and working with a great design team there, he kind of introduced this chiplet architecture to AMD that has let them get a architectural advantage over Intel in the server CPU market for really the first time since kind of the 0304 period, when AMD had something called 030405. AMD had something called the Opteron architecture. Basically, in the 20 years ago, Intel bet really big on, oh gosh, what was it called? Um, um, I don't remember. Itanium, and a new kind of almost a new instruction set.
Yep.
And AMD said, hey, we're just going to kind of stick to the existing one, do it better. They kind of were a little faster. They had multi-cores. But back then, AMD was they still made their own chips. They were not fabless. And so they literally could not fulfill demand. And Intel used their kind of manufacturing muscle and limitless capacity. They kind of slashed prices and basically said, hey, AMD can't fill your demand anyways, but if you go to them instead of staying exclusively on us, we're never going to remember it. We're never going to forget it. And, the next time, there's a shortage, we're not going to give you chips. And so they were able to kind of fight off AMD. Intel kind of really has gone through kind of a period in the wilderness where, they made some silly acquisitions. They bought Altera. They made a lot of silly acquisitions. They defocused, and they took their eye off the ball in manufacturing. And so for this current transition, Intel's 10 nanometer is roughly Taiwan Semi 7 nanometer. And Intel, for 50 years, has had a manufacturing advantage. I'd say on average, they're 9 to 18 months ahead of anyone else to each node. And given Moore's law, we all understand Moore's law, what it does for price performance. But so if you're 9 to 18 months ahead to each node, you have a massive embedded advantage. And so Intel had this incredible advantage built in. And manufacturing advantages in semiconductors, they're very, one of my favorite phrases is from a British historian called Arnold, I believe it's Arnold Toynbee, and he said, the lesson of history is empires are hard won and easily lost. And that goes for many other things like investment performance, fitness, but it also goes for, semiconductor manufacturing. So Intel, they're in the lead, and being in the lead is actually, it does give you a big advantage because it is like baking a cake and you kind of need to try out recipes. And so if you're ahead, you have longer to try out the recipe, so you get there faster. But Intel, they didn't use ASML's EUV tool. Taiwan Semi did. That was an arrogant decision by Intel. And they tried to increase the transistor density too much, which compounded the mistake. So they have lost their manufacturing lead. So now we have AMD. They have an architectural advantage because of this chiplet architecture from Jim Keller. And by the way, Jim Keller was also at Tesla, and he helped them develop their own ASIC that now is in every Tesla that does the inferencing for autopilot. And actually, he did a stint at Intel, and he helped them develop new chips that that we will see from Intel over the next 2 years. And he is truly a one-of-a-kind architect. And it's like almost wherever he goes, he kind of leaves magic behind. But so AMD has an architectural advantage, but because of Taiwan Semi, they also have a manufacturing process technology advantage. And then because Taiwan Semi has lots of capacity, they are theoretically going to be able to meet more demand than the last time they had an architectural advantage nearly 15 years ago. So we'll have to see what happens. But Intel, they do have that exorbitant privilege of software has been optimized for Intel processors. There are all these code libraries, code library for almost any kind of software, ranging from artificial intelligence to high performance computing, to scientific programs, to anything. It's been optimized for Intel CPUs, all those code libraries. So AMD has to be really good, but look, they're starting to take share. You can see that in the, in the kind of, in the AMD versus Intel chart there. But, we will see what happens going forward. Intel, we'll call it, I would say, 3 to 4 years late on 10 nanometer. They need to execute on 10 nanometer. They're gonna show their Tiger Lake client CPUs, which are kind of their mainstream Tiger Lake CPUs for laptops. They're going to show those, I think, highly likely in early September. But then the real test will be, can they run their 10 nanometer process on server CPUs? Because basically, server CPUs are always bigger than desktop and laptop CPUs. And as a chip gets bigger, yields become more important. Because you have to have a lower defect density. So, you make these chips on a wafer, they're 300 millimeter, they look like, pieces of copper or gold, and they're circles, and they're 12 inches in diameter. And if you're slicing that circle up into lots of different little dies that are going to be the CPUs, you can have a higher defect density because, let's say you're slicing that circle up into 1,000 different chips. And there's a defect on 5% of that circle. That means you're only going to be throwing away 50 chips. You're going to have 950 working chips. Well, if you're slicing that circle up into only, 20 or 30 or 50 chips, and those defects are randomly distributed, you might be only yielding 50% for that, for that defect density. So the real test of Intel's 10 nanometer process is going to come when they attempt to launch server CPUs, which are much bigger chips with bigger dies on that 10 nanometer process. And, we'll see. That's going to happen at the end of this year. And either it will happen or it won't. And if it happens, Intel will be on a better competitive footing versus AMD. If it if it doesn't happen for Intel, then AMD is going to have a really big advantage. And we're going to know that over the next 6 to 9 months. That's on the CPU side of things. Now, AMD and NVIDIA both compete head-to-head in GPUs, and Intel is about to come out with what looks like a very interesting GPU. And their GPU was actually designed by the former kind of head, another kind of processor rock star, probably not quite as famous as Jim Keller, who's now at Intel. And it looks like it's going to be a very interesting GPU. And I would say AMD does not, whereas AMD has a architecture advantage in CPUs, they're at an architectural disadvantage in GPUs. And the way you could see that was NVIDIA's 12 nanometer GPU was actually faster than AMD's 7 nanometer GPU, which is just simply astonishing. And we'll see. And AMD is going to come with a new architecture. And look, semiconductors, this is a high stakes game. NVIDIA, they are spending over $2 billion every 2 years to come out with a newer architecture. So cumulative venture funding into AI accelerators trying to compete with NVIDIA is $2.5 billion. NVIDIA is spending that every 2 years. And modern semiconductors, it is a brutal treadmill because you need to hit that next node every 2 to 3 years. And then because of the pace that NVIDIA is on, you need a new architecture every 2 to 3 years. So, every 2 to 3 years, all these companies, NVIDIA, Intel, and AMD, betting, and we should put Taiwan Semi in there too, TSM. TSM does the manufacturing for AMD and NVIDIA, whereas Intel does their own manufacturing. And it is just crazy. Every 2 to 3 years, Intel versus Taiwan Semi, they're making these huge bets in process technology. And they are literally spending $15 billion a year, and all for a recipe to get to the next node. And here they're using the semi equipment. And Intel bet wrong, and Taiwan Semi bet right, and Intel lost a 50-year leadership position. And that was because of a bet around EUV, and probably some other mistakes that Intel made. And then on the architecture side, every 2 to 3 years, NVIDIA, AMD, and Intel, they're making these huge bets, and ARM, who's now owned by SoftBank, on CPU architectures, on GPU architectures. And so these are consolidated markets, but you have to run really fast, and it is brutally competitive between all of these companies. And then on the GPU side, you have all these venture-funded competitors coming with exotic architectures. And then on the CPU side, for both Intel and AMD, you have this wave of ARM-based CPU startups coming. And then, existing players like Marvell, they have their own ARM CPU efforts. Although I'm probably more bullish on some of these startups. Some of these ARM server CPU startups have truly great design teams. So we'll see. But this is why I love semiconductor investing, because it is very high stakes. It's always changing. It's very technological. It's very exciting. And if you do have, and I've been doing it for 20 years, so I'm very comfortable doing it. So I love semis. But I would say, despite all those big bets and the high stakes, the history of semiconductors would suggest it is difficult to dethrone a dominant digital processor company. And that, because of that exorbitant privilege of having code libraries optimized for your own particular architecture.
Got it. Okay. Well, I feel like I just went through a master class in semiconductors and the different dynamics in the history. So really appreciate you sharing that knowledge. Wanted to finish off here on a couple of lighter notes. So I ask all my guests, everyone's in quarantine, everyone's watching Netflix or looking for stuff to watch. What's kind of been your favorite movie or TV show over the past 6 months, 12 months that you would recommend to people?
Well, so I was late to it, but I watched The Wire and I was blown away. I was really blown away. Look, Game of Thrones and Battlestar Galactica will always be my favorite TV shows. I will never forget those characters. Adama and Apollo and Starbuck from Battlestar Galactica, and Daenerys and Jon and Tyrion, and Cersei and Jaime from Game of Thrones. So those will always be kind of nearest and dearest to my heart, and I'm sure, I will rewatch them many times through my life. But in terms of, I think, just truly exceptional television, the two best TV shows I've ever watched are The Wire and Downton Abbey. And they're similar in the following way. And it's difficult to believe they didn't really happen. And The Wire, I'm actually trying to get my parents to watch The Wire right now. And it is so upset. The first few episodes are so upsetting. It's such a visceral, raw look at, the drug trade in inner city America. It feels so real. After seeing it, I've seen Idris Elba in so many things. He's one of the greatest actors of, this generation. And now I look at him, and it's hard for me not to think of Stringer Bell. In the same way, Downton Abbey, I can't quite believe it didn't really happen. I know that it was a television show, but part of me really believes that some film crew went back in time and filmed this British family, at this really pivotal point in kind of British history, where kind of the aristocracy, it was the decline of the aristocracy. World War I really started to break down the class system in Britain. There were all these wrenching social changes. It's hard to believe it didn't happen, and it's just hard for me to believe that The Wire did not happen. It just feels so real. And I think the scene with Stringer Bell and Avon Barksdale, where I don't want to ruin it.
Yeah.
I don't want to ruin it, but just the scene where they speak for the last time, I think is Shakespearean. There is nothing in any Shakespeare play that beats that scene for pathos, given what happens next. So The Wire is something that I've been late to, but I feel very grateful to have watched it.
That's awesome. So The Wire is my favorite show of all time, and I had no idea you were going to say that. And I actually rewatched it very recently, and it's just as good. And even though Downton Abbey is a fantastic show, I would argue The Wire finishes very strong, whereas Downton Abbey, for me at least, got a little bit kind of repetitive towards the end. And who's your favorite character in The Wire? And all the characters are just amazing.
Oh, Stringer Bell.
Stringer Bell.
I mean, come on, man.
Yeah. I mean, there's Omar's my favorite character.
Look, Stringer Bell, Omar, yeah. I think the pathos and the story arc of Stringer Bell, it almost reminds me of, in the Godfather Part 3, when Al Pacino's trying to kind of get out of, the business of crime, and he says, they keep pulling me back in. It's like Stringer Bell, that character arc is amazing. Omar, of course, he's a super cool character, because he's he's got his own code of justice. He's like Robin Hood. He preys on the drug dealers. So has a character, Omar is more appealing, but has a character arc. To me, you cannot beat Stringer Bell. And then just, obviously, we talked about, him and Avon Barksdale in the last conversation. And, obviously, Stringer and Omar Bell, they have a last conversation too. And those are the two scenes that will always stick with me from The Wire. So for sure, Omar's a great character, but I love the character arc and development of Stringer Bell.
I think you like Stringer Bell because if you had to choose one character that would be you, it would probably be Stringer Bell, because he goes to community college and learns finance and talks about supply and demand. And so just like you went from being a ski bum to kind of finance, I think Stringer Bell did to some degree had a transition as well. Awesome. And then just lastly, how do people follow you, your market views? What's the best place?
Look, I'm very active on Twitter and on Medium, and I love both platforms because I find Yeah, I try to embrace being wrong and love being wrong because definitionally, if you're not wrong, you're not learning, you're not updating your beliefs about the world. And I try not to have beliefs. I try to only have hypotheses. And so I'm quite active on Twitter and on Medium. And I find almost anything I post, my thinking is instantly sharpened. People criticize it, people disagree, people point out flaws in my logic. People, will sometimes tweet back at me things that kind of, support what I was saying, facts I was unaware of. It really does sometimes, it's just very additive to me as an investor to be able to be active on these platforms and have my thinking sharpened by this global community, of really brilliant people. Some of whom I know only by their Twitter handle. And I have no idea who they are or what they do in real life. I just know that they are brilliant and they have brilliant insights. And I think that's one of the coolest things about Twitter is, there are people who are entirely anonymous accounts and are brilliant and have huge followings and really contribute a lot to the discourse. And, it really is very meritocratic. Good ideas, good content rises to the top. And so I do love being active on those platforms and having my thinking criticized and sharpened by people all over the world.
Yeah, it's an amazing place, and I'm always surprised when I meet investors and they say they're not on Twitter because it's just such a wealth of information. Awesome, well, Gavin. Thanks again for being on our show, for sharing all this knowledge about semiconductors. Really appreciate it, and looking forward to hearing more of your views on Twitter and on Medium.
Awesome, thanks, Rob. Lots of love for Koyfin.
All right, bye bye.